Welcome to CATEX TV. My name is Frank Fortunato. Today is Thursday, February 9, 2012. It looks as if the Greek government has agreed to the austerity measures required by the Europeans, so the stock market may go up today. In London, Catlin has made a profit last year. They made a profit of $82 million. They're one of the few who have made a profit. The profit was down quite a bit from 2010, actually 78%, and they did pay out almost $1 billion in cat claims, but they still made a profit. Analysts had been expecting a profit of only $25 million, and they came in the 80s. One of the reasons that Catlin is making money is because of a lessening of a reliance on reinsurance and a move into more predictable delegated authority business. As part of that, Catlin announced that they are setting up 3 sidecars in order to act as quota share takers of the company's reinsurance programs beginning next year. Everest was not as fortunate. They announced that they joined the hit parade of Platinum, Axis, and Partner and are losing money for 2011. They're taking an $80 million loss for 2011 compared with making $600+ million last year. The billionaire hedge fund manager John Paulson, who has the biggest stake in the Hartford insurance company, is complaining to CEO Liam McGee about the low price of the Hartford stock. He said we need to do something drastic because the stock is the lowest valuation of any major insurance company. McGee said that the idea of following what Paulson is suggesting, splitting the life insurance and property and casualty businesses into 2 companies, would present significant challenges. Paulson says, what I want you to do is not merely come back and say, yes, we're looking at strategies. I want you to come back with a positive recommendation to separate these 2 businesses. The stock has declined almost 40% last year. That's what happens when you have foxes in the hen house. The American Association of Managing General Agents President Wayne Forrest said yesterday that unnecessary interference by the government is the biggest threat facing MGAs. I'm not quite sure what he means, but we're going to reach out to Mr. Forrest and see if we can talk to him. He said the biggest problem that we're going to face over the next few years is government intrusion. There's the potential to choke off innovation in the sector. Brian Earhart, who's the chairman of Aon Benfield Analytics, who's a very thoughtful commentator actually, had an interview in the Insurance Day today by the editor Richard Banks. Mr. Earhart mentions 2 very good points. He says that people tend to have short memories insofar as the effects of the earthquakes in Japan and in California in the 90s, and how the banks ended up owning the properties as mortgage holders simply walked away because they didn't have earthquake insurance. He said it's staggering to him that governments do not require, especially in the US and in Japan, that private homeowners carry earthquake insurance if only to protect the banks. He also noted that if in fact mandatory earthquake cover was compulsory in the U.S., it would have a dilutive effect, a reductive effect on the price of hurricane and wind and flood cover. He's spot on in this estimate. Actually, we've been wondering why this hasn't been the case for quite some time. Second day in a row now of a major strike in Israel. Public employee workers are striking. Parts of certain airports, trains are shut down. The strike is costing the country about $500 million a day. January's inflation reports in China showed an overheating economy again, 4.5% increase in consumer prices. This is the 4th month in a row. And in New Zealand, police are now investigating a report coming from the February earthquake of last year about the quick collapse of the CTV building during that quake, in which about 90 people were killed. The idea now is that the 6-story building pancaked upon the first rumbles, and in fact there are causes to believe, as a result of a report issued by the building inspector, that the building was constructed not up to